In 1989, the ground beneath the Imperial Palace in Tokyo was worth more than the entire state of California. In fact, by some calculations, the land value of Japan was 4 times greater than the entire United States of America. It was a mathematical impossibility, a delusion of wealth so staggering that it defied every law of economics. The Japanese people believed land would never go down. They believed they were different. They believed their economy had rewritten the rules of gravity. Then, the clock struck midnight. In the blink of an historical eye, values crashed by 80%. The sun went down on the Japanese economic miracle and didn't rise again for 30 years. Fast forward to 2007. The narrative had moved to Ireland. The Celtic Tiger was the envy of Europe. Taxi drivers were buying second and third investment condos. A nation of 4.5 million people was building enough housing for a population of 8 million. They were told property was the only safe bet. They were told soft landings were guaranteed. Then the music stopped. Prices collapsed by 50%. Entire neighborhoods, known as ghost estates, stood empty, rotting in the rain, monuments to a mania that bankrupted a nation. Fast forward again, China, 2021, the greatest construction boom in human history, 65 million empty apartments, enough to house the entire population of France. Developers like Evergrande were leveraged to the hilt, trading at valuations that assumed the urbanization of China would never end. But the math always wins. The collapse is happening right now, in real time, wiping out trillions in household wealth and leaving a generation with mortgages on homes that will never be finished. This pattern has destroyed 3 economic superpowers in the last 40 years. It is ruthless, it is repetitive, it is exact. And right now, in 2025, the United States housing market is following that exact same pattern, stage by stage, decision by decision, almost like we are reading from the same script that led to catastrophe every single time before. You are being told that supply is low. You are being told that prices have reached a new permanent plateau. You are being told that American real estate is the exception. But history has a very clear message for those who think they are special. The pattern doesn't care. To understand why the American housing market is standing on a precipice, we have to look at the blueprints of disaster.
We have to look at the first case study, Japan, 1985 to 1991. This is the original blueprint for the modern asset bubble. In the mid-1980s, Japan wasn't just a strong economy, it was an economic predator that was devouring the world. To combat a rising currency after the Plaza Accord in 1985, the Bank of Japan slashed interest rates from 5% to 2.5%. They opened the floodgates of liquidity. Corporate Japan didn't use this money to build factories. They used it to speculate on land. The statistics from the peak of this mania are almost hallucinogenic. At the height of the bubble in Tokyo, a simple square meter of land in the Ginza district cost over $300,000. Golf club memberships traded like stocks, some costing upwards of $3 million. Japanese corporations were valuing their land holdings higher than their actual business revenue. Banks were issuing 100-year mortgages, loans that would take 3 generations to pay off. It was stage 1 and stage 2 of the pattern in perfect synchronization. Credit expansion fueling speculative mania. Then came the turning point. The Bank of Japan realized the fire was burning too hot. They raised rates. The cheap money vanished. The acceleration of the collapse was brutal. The Nikkei stock market crashed first, losing nearly half its value in months, dragging real estate down with it. Commercial real estate values plummeted 87% from their peak. 87%. That is not a correction. That is an annihilation. The lost decade turned into the lost 30 years. Prices in some areas of Japan have still, to this day, never recovered their 1989 highs. But the world didn't learn. We just moved the location. Case Study 2, Ireland, 2000 to 2008. If Japan was a corporate bubble, Ireland was the retail bubble, the one that trapped the everyday person. In the early 2000s, Ireland joined the euro. Suddenly, a country used to high interest rates had access to German-level low interest rates. The credit hose was turned on. Irish banks began lending recklessly. At the peak, construction accounted for 25% of the Irish GDP. Think about that. 1/4 of the entire economy was just people building houses to sell to other people. House prices rose 500% in a decade. The average Dublin house price hit over 400,000 euros, while the average income remained modest.
People were leveraging equity in their primary home to buy apartments in Bulgaria and condos in Cork. The sentiment was euphoric. The soft landing was promised by politicians and bankers alike. Then, the global financial crisis hit. The credit tap turned off. The implosion was immediate. Prices crashed 50% nationally and up to 80% in rural areas. But the scariest statistic wasn't the price, it was the ghost estates. Over 600 housing developments were abandoned mid-construction. The government had to step in and demolish brand new houses because there was simply nobody to buy them. The Irish banking system collapsed so completely that the country lost its economic sovereignty and had to be bailed out by the IMF. They thought they were the Celtic Tiger. They were just the second victim of the pattern. And now, the third case study, China, 2010 to 2024. This is the most recent and arguably the largest financial event in human history. After the 2008 global crisis, China printed more money than the US, Europe, and Japan combined to stimulate their economy. That money poured into concrete. Real estate became 70% of Chinese household wealth. It was the only savings account they trusted. The numbers here are staggering. Developers like Evergrande built an empire on debt, pre-selling apartments that didn't exist to fund the debt on the previous projects. It was a Ponzi scheme made of steel and glass. By 2020, the vacancy rate was catastrophic. 65 million units sat empty. The price-to-income ratio in Beijing hit 50 to 1. That means it would take an average worker 50 years of their entire salary, spending nothing on food or tax, to buy an apartment. The government tried to deflate it slowly with the 3 red lines policy in 2020. But Ponzi schemes do not deflate, they burst. Evergrande collapsed with $300 billion in liabilities. Country Garden followed. Today, in 2025, across second and third tier Chinese cities, prices are down 30, 40, sometimes 50%, though official data tries to hide it. People are refusing to pay mortgages on unfinished homes. The social contract is breaking. The wealth of the middle class has evaporated because they believed the lie that real estate only goes up. 3 different cultures, 3 different decades, 1 identical outcome. This brings us to the mechanism itself. We need to strip away the noise and look at the engine of this destruction. This is the 4-stage real estate Ponzi pattern. It operates with mechanical precision, and once you see the stages, you cannot unsee them. Stage 1 is the credit hose. This is where central banks artificially suppress interest rates, or governments incentivize reckless lending. It decouples the cost of money from the risk of lending. In Japan, it was the post-Plaza Accord rates. In Ireland, it was the euro entry. In China, it was the post-2008 stimulus. Stage 2 is the mania. This is the psychological shift. Asset prices begin to rise faster than incomes. This creates a feedback loop. Rising prices attract speculators, which raises prices further. The narrative shifts from housing is shelter to housing is a financial instrument. FOMO, fear of missing out, becomes the dominant emotion. People buy because they are terrified they will be priced out forever. Stage 3 is the peak, also known as the Wile E Coyote moment. This is the most dangerous phase because, on the surface,
Prices are still high, but underneath, the fundamentals have rotted away. Yields turn negative. Rent no longer covers the mortgage. The asset is cash flow negative, held only for the hope of capital appreciation. But the pool of buyers, the greater fools, has been exhausted. There is no one left to buy at these prices. Stage 4 is the implosion. A catalyst occurs. A rate hike, a recession, a banking failure. Liquidity vanishes. Sellers rush for the exit, but the buyers are gone. Prices don't just slide, they gap down. Equity is wiped out. The economy enters a balance sheet recession, where everyone is paying down debt instead of spending, leading to years of stagnation. Now, look at the United States in 2025. We are not approaching the pattern, we are deep inside it. We are rewriting the final chapters of the same book that bankrupted Japan and broke Ireland. Let's apply the stages to the current US market. Stage 1, the credit hose. Check. In 2020 and 2021, the Federal Reserve pinned interest rates to zero and bought billions in mortgage-backed securities. We saw 2.7% mortgage rates. It was the cheapest money in American history. It flooded the system, allowing buyers to bid up prices by 40% in 2 years. The foundation of the current price level is built on a cost of capital that no longer exists. Stage 2, the mania. Check. We saw the same psychological break. Bidding wars on dilapidated shacks, institutions buying entire neighborhoods.
The narrative that housing is a shortage justified any price. The median home price in the US detached completely from the median income. Stage 3, the peak. Check. This is where we are right now. The data is screaming that the cliff is here. The home price to median income ratio in the United States is currently higher than it was in 2006, the peak of the last bubble. Higher. Read that again. It is harder to afford a home today than it was at the peak of the subprime mortgage crisis. But here is the specific metric that proves we are at the peak: the transaction freeze. Just like in Japan before the crash and Ireland in 2007, volume has collapsed. Sellers are clinging to 2022 prices, and buyers are physically unable to qualify for loans at 2025 rates. The market is paralyzed. This is the Wile E Coyote moment. We have run off the cliff, our legs are still spinning, but gravity hasn't taken hold yet. The shortage narrative is the last line of defense. Pundits claim prices can't crash because there is no inventory. They said the same thing in Ireland in 2007. Inventory is not low because there are no houses. Inventory is low because sellers are refusing to acknowledge the new reality. They are hoarding supply. But supply is not static. The moment the recession hits, the moment unemployment takes up, that hoarded supply floods the market. The lock-in effect of low mortgage rates works both ways. It keeps supply off the market until distress forces it on, and when distress hits, it hits all at once. So what does the future projection look like? What is stage 4 for the United States? We are seeing the early tremors. Commercial real estate is already imploding, just like it did in Japan first. Office towers in major cities are selling for fractions of their previous value. This destroys the balance sheets of regional banks. When those banks constrict lending, the residential market loses its lifeline. The next 12 to 24 months will likely see the great unlocking. As the unemployment rate rises, which historical patterns guarantee following a yield curve inversion, forced selling begins. The Airbnb hosts who are overleveraged, the flippers who got stuck, the boomers who need to downsize to fund retirement but can't find buyers. When the inventory unlocks, it will meet a buyer pool that has been decimated by inflation and high rates. That is when the price discovery happens. It won't be a slow decline.
Real estate crashes are sticky on the way down, then violent. You will see price cuts of 10%, then 20%, chasing the market down. The equity that homeowners think they have, that paper wealth gained since 2020, will evaporate. This brings us to the conclusion, and the most dangerous trap of all: American exceptionalism. Right now, you are probably thinking, but the US is the world reserve currency. We have the strongest economy. It's different here. That is exactly what the Japanese salaryman thought in 1988 as he signed a 100-year mortgage. That is exactly what the Irish property developer thought in 2006 as he broke ground on another estate. That is exactly what the Chinese investor thought in 2019. Every bubble is fueled by the belief that this time is different. But the math of leverage is universal. It does not care about your flag. It does not care about your military. It cares about debt-to-income ratios. It cares about cash flow. The pattern has completed 3 times in 3 major superpowers in the last 40 years. Japan, Ireland, China. 3 strikes. The pattern says we are next. The credit expansion has happened. The speculation has happened. The peak affordability crisis is here. The only thing left is the implosion. Maybe we have 6 months. Maybe we have a year. But the cycle is turning. The greatest transfer of wealth in history is about to occur, from those who are holding the bag of overvalued assets to those who are patient enough to wait for reality to return. The history books are written in patterns. The warning signs are flashing red. The question is not whether the crash is coming. The question is, will you be watching it happen, or will it happen to you?